Hi, this is Bob Iaccino talking crude oil futures from the CME Group trading floor in Chicago. Crude oil backwardation really having an effect. Now, backwardation is part of the fundamental story of crude oil, and the Brent crude oil curve is fully in backwardation, and WTI curve is headed that way. Now, what is backwardation? If you don't know, that means the further out futures contracts, the further out along the curve you go, the lower the price is. That's called backwardation. That is the normal state of the crude oil curve, and it generally means higher prices. Why is that? Because people want to get their crude oil out of their hands. It costs more to store it, because you pay for that storage and then you end up selling it at lower prices. So the spread is different. That means higher prices generally. That means people want to buy crude oil now because they think the price is going to be higher in the future. That actually is a little bit convoluted because the price is lower on the futures contract, but they're buying it now because they think it's going to be higher priced, pushes the front month higher. Again, the Brent curve is fully in backwardation. WTI is headed that way. You have to get out past June of next year before you see the WTI curve in backwardation, but it's moving toward the front month. We also have the talk of the cut extension, which is now taken over from the graceful exit to the production cut. Now, what do I mean by that? Well, earlier in the week, we had talk of OPEC gracefully exiting from this production cut, almost in the way that the central banks want to exit from their quantitative easing programs. But then we had Prince Mohammed bin Salman from Saudi Arabia, the crown prince of Saudi Arabia, say that of course he wanted to extend cuts. That's something Russian President Vladimir Putin said a few months back, but it carries more weight coming from the crown prince of Saudi Arabia, because now you have the two biggest producers in the world saying it. Granted, months apart, but it looks like we've gone from the talk of a graceful exit of the production cut to the market fully believing that the production cut is going to be extended, keeping crude above $54 on its way potentially to the December 30th highs from last year, 55.23 or so. Also, rig counts in the U.S. Obviously, that happened on Friday, but you need to look at the overall picture. We got an increase of one rig on Friday, and that now makes 10 of 13 weeks lower. And the 3 weeks that weren't lower in rig counts, this Friday included, +1, flat, and +1. This is very characteristic of a downtrend. You see little rallies that get sold when you're looking at a chart. Now, granted, this is not selling, they're not selling rigs. But when you see a trend like that, where you see a little bit of a relief from that trend, that generally is not a reversal of the trend, especially when you have so many of these weeks being negative. This is very characteristic of a downtrend in rigs. So it doesn't look like, at least at current prices, that the U.S. shale producers are going to rescue the decreasing inventories that we are seeing and the stronger demand going into those decreasing inventories, which seem to be pushing crude oil prices higher in the short to medium term. This is Bob Iaccino talking crude oil prices from the CME Group trading floor in Chicago.